Okay. Hi, thanks everyone for joining us today. I'm Kaylee, Relationship Manager with Saxo. And today we have Charu, our market strategist, with us to share our views on bonds that has been gaining traction recently. So to start off, we have seen quite a bit of volatility in 2022 for the markets, and there was a divergence between the equities and bond relationship at the start of the year. So, Charu, do you think it's possible for us to see a divergence again?
So yes, you're right, Kaylee. Thank you for that introduction. And yes, a lot of attention in bonds these days, as we can tell from our recent conversations with clients as well as the investing community. I think it is really timely, this discussion, as we head into the end of the year when traders and investors are really evaluating the performance of their portfolios and considering how to position for next year. We do think bonds can offer some nice income advantage now and also going into early 2023, as well as some diversification benefits from equities, which could face further pressures next year as well. So maybe I will just start by sharing some slides and take you through why I think that is the case. I hope you can see my slides now. Um, So, just a word of disclaimer to begin with, anything shared here is just for general knowledge and information, and none of this is really investing advice. And we will just start off with this first one here, where you can see, I mean, of course, on the top left chart, this year has been really tough for equity and fixed income investors alike, but even for those who had well diversified 60-40 kind of portfolios. And that's because equity and bond markets fell in tandem, which is usually not the case. Bonds have not been able to perform the function of really mitigating the risks of stock market sell-offs this year. And the key reason behind there was higher and unanchored inflation expectations. And that meant a rapid rise in interest rates this year globally, and also higher interest rates drove down equity valuations, and they also drove bond yields higher, so bond prices fell as well. Remember that bond prices are inversely proportional to bond yields. And as you can see from this chart on the right bottom side, most asset classes actually did quite poorly this year. There have been very few outperformers, mainly the US dollar and crude oil, which faced a major supply crunch as demand continued to hold up. So that was the reason. But again, yes, like I said, the question that we continue to get from investors is, should we abandon these 60-40 portfolios altogether now? And how can we diversify better going into the next year? I think to answer that, let me probably just take a step back first and let us discuss our key macro views going into the next year. So we at Saxo still remain in the inflation high for longer camp. We see a lot of reasons to remain concerned about inflation into the next year, as you can see on this chart here. Be it supply chain pressures that have really not resolved, or the push on green transformation, which will eventually lead to higher energy costs, especially when you don't have a secure and reliable baseload supply. We have concerns that the climate change will drive increasingly more supply shocks on agricultural products as well. So it will be difficult to have a steady, foreseeable supply of agricultural commodities, as we've had previously. And then, as you can see, these days, China reopening momentum has been gathering a lot of pace despite these short-term headwinds that they are facing because of the big rise in cases that they have, currently. But overall, there's a good level of, commitment from the authorities to really reopen and drive consumption higher, and that can potentially fuel, increases in industrial metals or as well as energy prices as well. You have other factors like rapid urbanization in India and other emerging markets as well, higher military spending. So, we firmly believe that the upswing that we are seeing in inflationary pressures is actually structural and is going to last for a long time. But with those inflation prints starting to cool now, as you've seen from the US over the last couple of months, even though we remain far away from target levels, I think going into 2023, markets will start to focus more on recession concerns. Uh, with inflation kind of plateauing at elevated levels. I think the way we moved from calling inflation transitory in 2022 to so entrenched in 2023, probably that's the kind of move we will see in terms of growth outlooks in 2023. But the Fed and other global central banks, they've done a lot this year. The Fed has raised rates by a cumulative of 425 basis points. So they will now, into 2023, at some point, they will need to just wait out for those interest rate hikes to play out and start to have an impact on demand, which can again bring the markets a little bit more in balance with supply remaining quite short. So we will start to see economic data deteriorating a little bit. The market is signaling recession risks as well, especially if you look at the bond markets. This chart is, it's the yield spread between the 3-month treasury bill versus the 10-year treasury note, which tumbled to minus 91 basis points last week when I actually took this chart from Bloomberg. Now, this indicator, 3-month to 10-year, is really the preferred indicator for Fed rather than the more popular 2-10 differential that the market usually uses to foretell a recession. And the level that we've seen here, as you can tell from this chart, every time we've seen such steep negative levels, you have a recession that follows in less than 12 months after it is reached. Those are the red zones, the recessions. But again, let me emphasize here at Saxo, we still believe that the hot labor market and wage growth means that if we do see a recession in the US, it potentially won't be very steep. I think the labor market will kind of put a floor to how steep a recession can be. But what I'm trying to say here is the markets will be a lot more concerned about it, and markets will start to price in, some amount of economic deacceleration there. So, with that kind of a macro backdrop in place, let's get back to, our discussion on bonds and why they are becoming relevant again in this macro backdrop. One reason is certainly diversification, especially considering, our equity view that we could see lower lows ahead. So whatever slide we saw in equities in 2022 has come on the back of higher interest rates. And because of that, the related adjustment that we've had to make in the valuation of equities. But going into 2023, we believe that equities could face, even more headwinds as these high interest rates are maintained. So that will continue. We don't expect rate cuts to start coming in 2023 because inflation remains a problem. But at the same time, we also expect companies to, continue to face wage pressures. But this year, when they faced the wage pressures, they had the ability to pass on those costs to consumers, which will not be the case in 2023. Consumers have already used up their excess savings. They're already looking a bit stretched, and they're already looking a bit concerned about recessions now. So the companies will not be able to, generate so much pricing power, which believe there will be a lot more margin pressure to come in 2023. And then, right now we have analysts expecting about 7.5% earnings growth in 2023. We believe that's really stretched. We will not probably not get anywhere close to that. And then recession risks, again, that will mean higher equity risk premiums. So again, it's best to diversify whatever exposure you have in equities. So I think diversification is certainly one point, but the other thing is the coupon income from bonds is very attractive now after years of low yield and followed by a brutal drop in prices in 2022. Returns in the fixed income markets are now looking poised for a rebound. It's likely to be a bumpy ride because that's what the macro backdrop is telling us. It's not nothing can be said with certainty, right? So but now in early 2023, perhaps it is a great time to start to lock in those high yields that we are getting in the fixed income market. For instance, if you look at a portfolio of say high quality bonds, treasuries and other government bonds, and as well as some investment grade corporate bonds, you can get yields of about 4 to 5% without taking up excessive risks. And not just nominal yields, real yields have increased as well. So I think that's really one reason why more and more investors are looking to adding bonds to their portfolio. And lastly, I think bond investors can also hope for some capital appreciation, assuming that the Fed and other global central banks will at some point start to cut rate, if not 2023, late 2023, maybe early 2024. But those expectations of rate cuts will also in 2023 mean that bond yields start to go lower. So bond prices start to go higher, and that will give you some capital appreciation. At the right here, we are just showing on the slide how many different types of bonds are there. There's government bonds, there's corporate bonds, which can be, like I said, investment grade or high yield. I'll come to all of that on the next slide, explain all of that a little bit later on. There's also inflation linked bonds. I think that's about it in terms of what we will cover in today's webinar. I mean, that's the scope we have today. But before we do that, maybe I'll pause here now and maybe hand over to Kaylee to show you Saxo's bond universe and how you can navigate that and start adding bonds to your portfolio if that interests you. Also, before we jump onto that, probably just a quick reminder that you can post questions that we can take at the end of this webinar. So I think probably on the right side of your screen somewhere you have the option to post some questions, or to pop any questions that you might have in that box there. Over to you, Kaylee.
Okay, thanks, Charu. Okay, so now I believe all of you should be able to see this live trial account that I have in front of me. So pretty much, given that we're a multi-asset platform, you'll be able to see most of all of our asset classes over here through the screener. If you do have like an instrument in mind, for example, if you want to look at Apple bonds, we can also sit here along with the other CFDs, equities, and equity options that we offer. So assuming you're pretty new to bonds and then you want to start from scratch, you can see on the screen over here, you can filter for bonds. Okay, so let's start with an ETF example first, because there's also the way to gain exposure using fixed income ETFs. So through ETFs, you can see under asset class, you can choose specifically for the fixed income option. And from here, pretty much like the rest of what you have on your watch list, you can see the last traded, what's the percentage increase for today, and so on. But let's say you want to go straight to the bonds itself. You can filter for that here. And under the issuer type, you can choose either corporate bonds only, or if you want government bonds only. Okay. So once that is done, you can see over here that there might be fields that are more relevant only to bonds. I've included mid yield over here, and you can also include that under managed columns, and if you search for mid yield. So once you have it added over here as a column, you can then filter according to what gives you the highest yield for the different bonds. Okay, so pretty much you can easily click on this, and we'll go through more on how you can look at how to trade bonds through like a trade ticket for online tradable bonds. So now that you've seen pretty much how to navigate that, let's go back to our macro views and see what type of bonds could be interesting for next year if you want to add them to your portfolio.
Right. Thank you, Kaylee, for running us through that on the platform. So if you do want to add bonds to your portfolio, I think there are a few things to consider. As you can see on the slide, like we discussed, there are government bonds, something like US treasuries, that are considered to be the safest, and they're frequently used as a benchmark for other bonds too. Then we have the UK gilts or Japanese government bonds and other sovereign debt as well. A number of governments also issue sovereign bonds that are linked to inflation. Those are called inflation linked bonds, or in the US specifically, they're called Treasury Inflation Protected Securities, or TIPS, as we commonly heard of. So on an inflation linked bond, what happens is that the interest or the principal is adjusted on a regular basis to reflect the changes in the rate of inflation as well. So you basically get an inflation adjusted return. But unlike other bonds, inflation-linked bonds could experience, greater losses when real interest rates are moving much faster than nominal interest rates. Then the second category that you have have is the corporate bonds, which we can, where you can consider the investment grades or the high yields, which is also called junk. This depends on credit ratings by the different agencies. I've just put a snapshot of that on the right side. So those with the lower credit ratings, something below triple B by Fitch and S&P, as you can see here, they have a higher chances of a default. So they will have to offer higher yields to attract investors. So high risk, high return. But most corporates typically have, generally more credit risk and therefore higher yields than government bonds in general, or if you look at similar maturities. And this divergence between the two creates a credit spread between corporate and government bonds. So, so that the corporate bond investor would usually earn some extra yield because he's taking up extra risk as well. I mean, you can see that on the chart on the bottom graphically, what a credit spread really means. The other key thing to consider is the interest rate risk. I mean, rates can move differently to what you perceive them to be, and that's why we need to be really cautious about what maturity we are exposing ourselves to. Duration risk, as it is often called, I'm not going to go into a lot of detail here, but it's something like maturity, not exactly similar. But that's something you need to, of course, keep in mind as well. And I think lastly, something which we maybe sometimes forget is that we also need to watch for liquidity of the bond that we are considering. So, as Kelly said, jumping onto the most interesting part, which bonds are looking attractive as of now. So going back to our view on inflation being higher for longer, we think that it's an environment where tips generally do well. The inflation protected securities that we talked about, real yields is a key factor to consider for these inflation linked bonds, and total return from inflation linked bonds will usually outperform nominal bonds when real yields are falling. So what that means is that inflation linked bond prices will increase if real yields go down. Inverse relationship between prices and yields, but for inflation linked you have to have the relationship with real yields. So that's the inverse correlation they have there. And the coupons are paid on a principle that is adjusted for inflation, so your coupon keeps going higher as well if inflation is rising as we expected to. So if you consider that real yields will decline, with inflation remaining higher and Fed at some point has to stop hiking rates, that means tips can be interesting in this environment. Moving along, I think also in terms of which part of the yield curve would generally be attractive or could be considered, we think the short end of the yield curve still faces some headwinds, because the Fed is not really done yet with its rate hikes. It's only adjusting its pace. We've seen a 50 basis points move in December. We could see another 25 or 50 in February, but we are still at a pace where we are hiking, and there is still a risk, that the Fed is projecting a 5.1% terminal rates. We could go higher than that, and that has been hinted by some of the Fed speakers as well. So the short end of the curve through the 2-year notes is likely to continue to, the yields will likely continue to rise to absorb that Fed hawkishness. So that obviously is potentially the risk that these short ends face. But on the other hand, you have yields from 3 years onwards, which may be poised to fall to reflect the outcome of, that the inflation gets anchored, long-term inflation rates get anchored, and growth starts to deteriorate. So the 3 to 7 year is giving me that kind of a sense, and that is why it's potentially the most attractive at this point. 10 years, I mean, or something beyond 7 years, they do not really offer the reward that you would expect to take that kind of risk. I mean, 10-year yields are offering less reward for now with more risk, especially if you consider that the curve will also re-steepen once the recession starts or the Fed starts to cut rates. So that's why I think probably 3 to 7 looks the most attractive right now. And if you look at corporate side, so the investment grades, like I said, they're offering over 5% kind of yields. So that's very interesting as well. These yield levels have not really been seen since 2009. So even if the economic picture worsens, companies may be better placed to withstand it than in previous downturns because corporate balance sheets have strengthened since 2020. With those fiscal easing that we saw coming through. Importantly, also the current slowdown is very different from previous downturns, because it's really a result of inflation, and it's clearly a result of the rapid increase in interest rates that we've seen this year. Um, Whereas previously, whenever we had bear markets, mostly they were because of, say something like a tech bubble or a global financial crisis, which came because of the concerns around, creditworthiness of the US housing sector or some other, assets, so overvalued tech stocks, some of those reasons which were really related to the corporate side of the equation. But for now, that is not the case. We do, like I said, of course, feel that equities could face more pressure going forward in terms of margins, but it's about picking and choosing the sectors that have that pricing power, and will be able to still do well. And of course, debt is still more reliable than the equity side for corporates as well. So, and of course, again, given our view that we don't expect a steep recession in the US, I think I would think it's corporate is still better than government bonds, which still face the risk of a possible fiscal expansion next year if demand slows down far steeper than what it is expected to. For the high yield side, we think there isn't really enough compensation for the extra risk you are taking. So as you can see with this chart on the right side here, currently the US high yield corporate bonds on average are yielding 305 basis points more than investment grade bonds. And that's pretty much lower than what they were yielding in the past recessions. So recession concerns will mean that investors should demand higher yields if they are taking an exposure to especially to high yield, right? So I think that's why the yield differential is not enough right now to entice investors towards high yields. Better buying opportunities could emerge in high yield corporate bonds when the US economy slips deep into an economic downturn, or the onset of a recession sees bad news or pessimism hitting in, and credit spreads could become excessively wide and more than sufficient to really compensate for the risks that are there. And then probably that would be a good time to consider some exposure to high yield as well. But lastly, I think just remember that after the recent sharp decline that we've seen in yields, it may pay off for investors to be patient and wait for those yields to bounce again before gradually adding bonds to their portfolios through the first quarter 2023. I mean, it's better to do it in a gradual manner rather than, I think, taking a large position in bonds at one go at the current yields levels. I think that's it from me, Kelly. Maybe you can show our viewers if these views make sense to them. How can they really navigate our platform to express these views as well?
Thanks, Charu. Okay, so now for us to see how it looks like on the platform to look at placing the trade. Where we left off was to filter for bonds showing government bonds. So let's say after our webinar today, you've taken interest in inflation-linked bonds. So you can actually type in ILB. And once that's done, you can see all the names of the bonds we have that's inflation-linked bonds. And like what we mentioned earlier, there's this mid yield where you can filter for the one with the best yield to maturity, looking at a mid price. And using this as an example, as for all other products, once you click on this, it would show automatically under the product overview. So with the trade ticket open, you can see that, let's say, your nominal value is about 100,000. We'll factor in the current ask price, and you will notice that the market value does not just show 110,000. So the reason for this is because for inflation-linked bonds, we have to take into account the index ratio, which takes into account the inflation index. So if you multiply this 410230 by this 1.19, this will give you the market value that you have to account for to actually enter into this inflation-linked bonds. So under cost, as per usual, you'll be directed to see, what's our commission rates, which we'll cover more later with our new subscription model. And this is also automatically calculated for you. So once you've placed the order, when the market's open, you will see that it will appear here. And once it's, entered into a position, it will appear under this position tab as per usual. So one of the few questions that we usually have is, what's the difference between trading the bond ETF versus bonds? So, Chari, if you can kindly switch back to the slides. We've done a quick comparison table. So essentially, if we look at some of the benefits of trading bonds directly, is that if you do not intend to trade in and out of bonds, this actually gives you the ability to preserve your capital if there's no default of the bond itself. Apart from that, you will be able to customize your own portfolio based on your risk appetite and your cash flow concerns, and also again, barring default, you'll be able to see this as a form of passive fixed income, given that there's relatively high coupon rates that was mentioned by Charu earlier. On the other hand, if we look at bond ETFs, the good thing about bond ETFs is that there's no maturity date. So you do not have to be, concerned about when you have to reinvest again. There's also the ability to diversify with a relatively low cost. So that can be managed for you by bond professionals, and you'll be able to, with a limited capital, go into a wide variation of different bonds. However, some of the disadvantages for us to note for both of these is that for bonds, liquidity tends to be thinner. It's because it's still an over-the-counter traded product. So you'll notice that after you have entered a bond order, you have to note that you have to take note to see when it's actually executed, or you can revise that limit order. Even though we have also lowered down the minimum investment amount for bonds, for you to be equally diversified compared to bond ETFs, you will still need to have a relatively large capital. The one thing to note for bond ETF side is that because you don't actually get the even if there's no default, you don't actually get your capital back at the end of the maturity date. So this actually really depends on whether the interest rate increase and whether that the timing of you entering into the ETFs may be relatively more important. So that's something for investors to think about when it comes to choosing your bond investments. If we move on to some examples of bond ETFs, we have taken a few names that investors may be interested in when it comes to government bonds, especially. We have highlighted earlier that the duration of 3 to 7 years might be more interesting for this point in time. But if you also have interest in other duration, you can see the different bond ETF tickers that you can gain exposure in across the yield curves as well. If you're looking at investment grade bond ETFs, you can look at names like LQD, and also we have some high yield alternative that USHY for you to consider. So if we now move on to our rates, we have recently wrote out our subscription model. So you can see that the rates are still very competitive in Singapore. And you can see, from platinum onwards, you get even better rates for online tradable bonds. I've included the link over here if you're interested to see, what our bond commissions are like. This is just a snapshot of our government bonds, but we also have an equivalent page for the corporate ones. An easy way for you to see the trading rates can also be through the I button over here that's highlighted under product overview. So like what we have shown earlier, if you're able to search for the instrument straight through instrument search, or if you've also identified it through the screener, you can click on I. This will bring you to the trading rates, and that will automatically show you the rates for your subscription plan. So you don't have to go to the website and filter out to decide which category your bond falls under. For us to also show you more about our bonds, we have also included a research page specifically for bonds over here. You can see that we have included market squawks by our sales trading team. That's more up-to-date news. And you can also easily navigate to our bond screener through this page over here. Lastly, below, we've also included some themes for you to look at that's catered more for the APAC market. So there's Chinese bonds included, and then some stable income. We've also included Islamic bonds for clients who are interested. So you can easily, look for trading inspiration over here. And we've also included one on fixed income ETFs at the bottom right of the thematic watch list. if you're relatively new to bonds as well, you can also see more on bond educational videos, how we calculate how do we calculate the yield to maturity, how the bond price is being derived as well. And you can see we'll also include more of this kind of bonds webinar going forward. So yeah, I think we have come to the end of this webinar where we've showcased more of our views as well as how you can navigate our bonds research page as well as the trade tickets. So yeah, do we have any questions for us, Charu?
Um, yeah, I think there's one question on how, you know, they can select the particular bonds in the platform, and the notional amount, and how does that make a difference? So maybe do you want to show that again?
Okay, sure. So let me share my screen quickly. So yes, if you go to, let's say we use this as an example, how you can do that is to look at the trade. If let's say you're looking at, what's the minimum nominal size, you can look at it over here. Most of our US treasuries, the minimum trade size is only 100 USD, but you can confirm again through the instrument page, trading conditions. And then once you go back here, you can choose the nominal value over here. So the earlier example that we used was 100,000. But we'll factor in, the ask price as well. So let's say you can look at the market value as to how much cash you need to have in the account. If you want to reduce that size, you can reduce that accordingly since the minimum is 100.
Right. I think that brings us to the end of this discussion as well. And if you have more questions, of course, feel free to reach out to Kaylee or myself or any of your other sales representatives. I think we'll be happy to help you with our macro views or guide you through the platform to understand how this can be done. Of course, I mean, like a lot of investors have not been into bonds for so many years because of the kind of yields that we had. So it's probably a very new asset class, at least for the retail clients that we have. So it will be a pleasure to really guide you through how we can do that. Okay, so I think we probably have one more question, Kaylee. How does one find out the duration of an underlying that an ETF holds?
The duration on the underlying ETF, it's really, I think the best way to do so is to check the ETF page itself. We've given an indication of some of it. So, for example, if I look at LQD on the platform, okay, some of it during the name itself, we would include the duration. Sorry for this one. I think they don't have it, but the best way would definitely be to see the actual ETF page. So we'll be sending the slides out after this. And for the ones that were featured on the slides itself, there's this link that links you to BlackRock, which has quite a number of government bond ETFs, and you can see the different duration that they feature in that ETF itself.
Okay, I think we'll probably stop here. And like I said earlier, feel free to send in your questions, or if you want us to, give you a platform walkthrough, I think we'll be happy to do that. Thank you for joining us today. It was a pleasure speaking with all of you, and hope you found this useful. And happy and safe festive season ahead for everyone.
Yeah. Thank you.